Now to our panel. Humilis's Brian Belsky, Requisite Capital's Bryn Talkington, Capital Area Planning's Malcolm Ethridge. Bryn and Malcolm are CNBC contributors. Good to have everybody with us. Bryn, you feel like you have a good handle on what the makeup of this market is, because it's been changing a bit, and I'm not sure people fully believe in this momentum bounce, at least on this day.
I think when you look at Micron, Intel, AMD, DRAM, the ETF, they just hit the 10-day moving average on Friday, and they're bouncing right off of that. And so while the MTUM ETF, which Dom did a great job, has some other things like energy that don't have really anything to do with the AI trade, those pure memory names, those pure AI names are bouncing right off of that 10-day moving average, which tells me that by the dip, the technicals, we got a little bit of a breather. The market's broadening out. But I don't think this is the beginning of the end of this specific momentum trade within these DRAM memory names at this point.
Malcolm, this is a good-looking market. I mean, there's not much to hate on. If you look at what's happening today, I said Dow above 53K, first time ever. You got technology back with the NASDAQ. The Russell continues to perform well. Ed Yardeni says S&P can go up another 10% this year. 8250 is his target. Oppenheimer says you can go to 8100. They're standing by that. That makes sense to you?
It does and it doesn't. I think in the near term, as we talk about turning the corner into Q2 earnings, and I think to the point Bryn just made, really what we're seeing, this bounce back that we're seeing, is a lot of investors that realize they got offsides a little bit, getting out of those semi names ahead of Q2 earnings, because earnings expectations are something like 23% above the last earnings period, which was already a bang-up quarter, double-digit growth that time. But half of it, more than the lion's share of it, is coming from the semi names, and probably only 3 or 4 semi names. So near term, I think it's probably a great trade that's going to pay off for a number of people, especially those that have piled into the stocks all over again, because I think that's up like 80% or something in the last 3 months, let alone what it's doing today. So it'll be a great trade until the earnings period comes and we get the actual news. So the rumor's been great. The news will change things, but I think realistically going forward, the second half of the year is probably going to be more challenged, because the hyperscalers, if all they do is reaffirm their spending targets, we could see them get punished the same way that Broadcom did last month, when all they did was reaffirm their earnings revenue targets that they expected, and the market punished them for that, not increasing it the way that they thought they should be.
Well, maybe, I mean, it's certainly better than decreasing it. I don't think the market would be happy to see that. Brian, what do you think here? You know, we're going to have, I mean, the Ed Yardeni target is based on what he calls fabulous earnings momentum, FEMO, not FOMO. And if you look at the scorecard, really, of where expectations are, man, there's a lot to live up to. I get it, but they're going to be robust. 24.4% earnings growth expected overall for the S&P 500, 65.5% of that coming simply from technology.
Well, that's exactly right, and Ed's got it right. You know, the market's probably going to close well above 8,000. You got to continue to ride your winners. I learned that a long time ago. Don't try to outsmart the market. I think where people have to be at least leery of post-second quarter earnings is this whole second derivative, less positive for third and fourth quarter, Scott. Are we going to be able to put up 65 or 70% earnings for the third quarter? I think it might be tougher, especially given the fact people forget that from a seasonality standpoint, just from a fundamental seasonality standpoint, second quarter earnings are usually slower. Yeah, it's different this time, what we're seeing in the numbers, but I think you have to be a little bit cautious in terms of post-earnings. Going into earnings, this market's heading higher, and the momentum is clearly on its side.
But Brian, when you say you want to ride your winners, I mean that's sort of what I was alluding to at the very top. What was a winner in the 2/3 part of this quarter ended up not looking so great over the final third. And now we begin this new month and new quarter, and now all of a sudden we've got momentum, at least for a day. I mean, it's not a trend, obviously, in a day, but I think that's confusing as to what the winners are going to be, which ones to actually ride when you just thought that maybe momentum was going away, and then other parts of the market were going to be the ones that were going to carry the load.
Well, I think there's two parts to momentum that most people are missing, Scott. Momentum's not just about price, it's about earnings, and that's where Ed's note is amazing and how he talks about it in terms of the earnings momentum. What we're saying is own the dip, don't chase the dip, meaning the dip in some of these memory stocks, I think, are going to be a little bit more near term. It's all about the scarcity of these products, quite frankly. The minute that you hear about less scarcity and catching up with demand, these stocks we think are going to get rocked. Why? Because really it's the fundamental base of the hyperscalers, we believe, the Microsofts, the Oracles, the Palantirs, that are actually building out the AI. We actually think those are going to be the ones you want to own on the dip and ride the earnings momentum longer term in those names, which we think is going to come back.
I'm surprised, Malcolm, that you think that you could actually get an earnings-related sell-off, even if earnings live up to what the hype is, which I just gave you the numbers.
Well, because I think we all have to acknowledge that there has to be some end in sight, right? There's only so much longer that the four hyperscalers that have been responsible for so much of this CapEx can continue to quarter after quarter tell us that they're going to increase what that spending number is. I have grown skeptical of their willingness to continue to increase those numbers, even in the back half of 2026. When I just look at a Microsoft, for example, which is down, I don't know, 20% or something year to date, while the rest of the tech sector is doing so great, they've been doing everything that they can to message the last couple of days around layoffs and the need to do these layoffs to find religion around spending, and they expect things to turn around and to right the ship in 2027. So I think that that is one of the canaries that's telling us that the four companies doing the majority of the spending can't spend forever. A lot of other companies are having to borrow to continue that spending binge now. We've seen, you mentioned Oracle at the top of this. They're a company that's been punished again and again and again for finding ways to bring more dollars into their war chest to get to spend again. And it's only so much longer that investors are going to continue to reward those companies. And the moment that they decide not to, that means also the second order effects, the chips companies, the data centers, the neo clouds, all of that has to start to come crashing down on top of itself because it's all built on the spending commitments of the hyperscalers.
Makes sense to you, Bryn?
Well, I mean, it makes sense, though, but I think that where he's a little bit wrong is you're missing two of the other big spenders, which are the two private companies, OpenAI and Anthropic. As long as they're private, they're going to keep being able to raise a ton of money. On top of that, I haven't listened to one smart person on a podcast who is in the know that says they're even remotely about to have excess compute. I mean, all you hear from the smartest people out there is we are compute constrained. I think we'll continue to get some of the air come out of the balloon like we saw last week in the memory names, but I think it's going to continue to build. And by the way, don't forget, the biggest driver of earnings growth is who? Drum roll. Micron and NVIDIA. So that is why we're going to continue to have strong earnings. Those two companies are the lion's share of the growth we'll have for the full S&P this year. So I think we'll have little panic attacks, but I don't think the end is near on this trade.
Right, because Malcolm, when you hear people come on, they're talking about runways lasting into late 27 into even 2028. Now, no one's going to fault you for being a little more cautious, but if you go back to 96, for example, and say, well, Alan Greenspan rang the bell, and if we would have gotten out then, we would have missed 3 to 4 years worth of gains in the space, albeit it ended poorly. And I'm not suggesting it either way that this is going to end if and when it ever does, but there is something to be said about growing too cautious too soon.
Yeah, I appreciate you framing that way, because I'm not necessarily saying we all need to get out of the market entirely, sell everything you got and go to cash. What I'm saying is a lot more of the speculative stuff that we're seeing, the 3 times leveraged ETFs, the 2 times leveraged ETFs on a single stock, those kinds of things. Like NVIDIA, for example, is a company that its spending commitments are probably going to come to fruition more than most other chip companies. So if you own NVIDIA as a way to play the AI trade, you want to be in the chip names, I feel very comfortable about owning that name. And I think you're even having a setup for an opportunity to be buying the dip that's happening in NVIDIA right now, in comparison to a lot of the other companies that don't have the level, the ability to build out their capacity to meet this supply that we're talking, or the demand that we've been talking about, in time to actually do anything with it while the excitement is there. The market's rewarding you for it. The build out is going to take longer than 2027 or 2028 from these big chip companies to actually meet the demand that exists today. So when we talk about compute constraints, realistically, the companies who have these constraints are going to find other ways tomorrow morning to solve them rather than wait for a Micron or someone else to be able to build out the necessary capacity to meet them where they are.
You do, Brian, have people coming on this program and talking about an everything rally also. And by the way, we're now at least 10% year-to-date gains on all of the major averages, right? The Dow is the worst performer year-to-date at 10.2. The S&P is up 10.23. Russell outpaces everything at 21.5%, and then the NASDAQ at 12.5. But what about the idea of an everything rally? Like, you need to broaden out your exposure across this market, and you're going to be rewarded if you do that.
Well, look at the
we really think so. And
hold on, Brian. Sorry.
You really think so?
Brian, go ahead. Go ahead. Brian, go ahead.
I'm sorry. If you take a look at what's happened in small cap land, as you said, but the small cap index within the S&P, the SML actually has better quality earnings, and that was up over 20% as well. But you have cash flow coming back in. Mid-cap stocks are working. Financials are working. Industrials, not just Caterpillar, not just Uber, not just Delta, but other names within industrials. We saw in healthcare starting to come back. So an everything rally to us makes fundamental sense. It's actually much more positive than chasing the markets. By the way, in 1996, Mr. Greenspan's speech was about the Nifty 50 stocks, and GE, Coca-Cola, Pepsi, Procter & Gamble, and Gillette all trading at 50 times earnings. It was well before the technology silliness. So are we anywhere near that? No, we're not. But at the end of the day, we think a broadly distributed rally in terms of U.S. stocks makes a lot more sense. It's actually much more fundamentally sound.
Because, Bryn, it's time to look at, some say, the beneficiaries, right? Healthcare of AI, healthcare going up and waking up, not by any epiphany. It's the fact of the matter that people are now looking beyond the hyperscalers for you've moved from the spenders to those companies that are going to benefit from all of the AI that is going to be enabled around the economy. And it's the healthcare names and all sorts of other areas that are next to get the catch up.
And I think that's why J&J is one of the top holdings in MTUM, is because AbbVie, Lilly, J&J, all these companies are going to be buying biotech companies. They're going to have their own AI models. And that's where this stuff gets really cool, of being able to cure really hard diseases. And so I think that the beneficiaries within healthcare, especially those three names, I think will continue to catch a bid with what they're able to do actually with their own internal IP around AI. I think it'll be really exciting over the next few years. I think that'll be secular, not cyclical.
Malcolm, what's the sleeper sector for the rest of the year? What do you think is going to do well?
It's probably not much of a sleeper sector because it's also doing well already, but I think financials are probably the more durable way to play the rest of the year, simply because we don't have to choose which companies within the tech sector are going to be the biggest beneficiaries and figure out how to weaponize AI and turn it on their own companies and their customers' companies to really grow their top line. The big banks are going to participate in all of that activity, no matter which companies come out to be the front runners. And so I think the big six, specifically the GSIBs, all the ones with the really big investment banking units, are going to be the place that you want to be in the back half of this year to take advantage of that.
I know Brian Belsky's not going to argue with you, right, Brian?
Oh, I love financials, but I think the big thing on the small cap financials, because they're such high quality, not only earners but borrowers, and I really think that the small cap financials are really going to be a place where people are going to see a lot of profit growth, but also a lot of great stock performance as well.
All right, got another big story today, of course, as we watch shares of SpaceX, because the stock getting added to the NASDAQ 100 following today's close. Leslie Picker's following the money for us on what all this means. Hi.
Hey, Scott. Yeah, in about 45 minutes, index funds that track the NASDAQ 100 will have to start buying SpaceX stock, whether they want to or not. JP Morgan estimates there will be about $4.3 billion worth of forced purchases flows into SpaceX by funds that have to reflect its weighting in the composite before it officially appears there tomorrow morning. SpaceX's weight in the NASDAQ 100 will be very small at first, less than 1%, but it will grow as SpaceX's public public float does. We'll see that happen as the company starts to lift its lockups, allowing insiders to sell. That could start as soon as next month. And then SpaceX may opt to do secondary offerings over time, which would bolster the float size as well. SpaceX shares, they're lower today, down by about 3.4%, despite the prospect of tonight's flows. But markets tend to front-run these rebalances, especially ones as telegraphed as SpaceX's. So the expected forced buying is likely already reflected in the stock price. Scott.
No, interesting. Les, thank you. Leslie Picker. Bryn, you own it in several funds, or at least various ways. What do you make of this?
I still think it's too expensive. I mean, I still can't wrap my arm around $2 trillion market cap, while Micron, I think, has 1.13. This is going to come in. I mean, Leslie's done great reporting at what, 0.5 to 1%. And so I think, it'll be in the index. It'll get a modicum of flows. But I just still think this is a lot of pull forward on a spectacular company with, like, Gwen Shotwell is amazing. The whole team is amazing. I just think as an investor, $2 trillion pulls a heck of a lot forward that has yet to manifest itself.
I hear you, but hey, look, you own Tesla, don't you?
Yeah, but it's not. Yeah, I mean, Tesla is delivering models. They stopped doing the X and the S to create the robots, Optimus, and it's not even remotely at the type of valuation that SpaceX is. So, I mean, I would love to buy SpaceX like 50% lower than this. I've said this before, Scott. I feel very strongly the exponential returns for SpaceX happened in the private market. I think there will be linear returns in the public market. SpaceX was private for years. And so I just think most of the returns happened for us investors who didn't get to participate while it was private. In the public market, I think the valuation is going to continue to be an overhang.
Oh, well, which is why you've got, people saying, well, it already IPO'd. I mean, it was in the private market forever. So the biggest rewards have already been realized by the professional investors and certainly some high net worth investors who are able to get access to that. Malcolm, how do you see this one?
Yeah, I think that the put that was under SpaceX once upon a time by people who were able to rationalize that valuation or justify buying it, we're saying, well, it's going to get included in all of the indexes eventually, and so that's the put underneath those shares. That's why you'd want to buy it on IPO day or soon after. And I think what we're seeing today is a selling of that news. It's now we have the actual inclusion. This is the event that I was buying it on the back of. It didn't actually move the needle the way that I thought it might be, and so you might have folks falling out of love with the idea of that trade, at least in the near term.
Brian, quick thought from you on this?
Yeah, we typically don't buy IPOs until they are out in the public market for at least 2 quarters. I want to see how they're talking to the public, number one. Number two, we've owned Tesla, and we still think that that's the play that the two companies are going to merge within the next year or so.
Guys, we'll talk to all of you soon. Appreciate the time. Brian, Brennan, Malcolm.